The structure of illiquid investing and private debt in this country, by definition, is illiquid. It's not on capital markets. It doesn't have a QSIP and an ISIN that you can trade on a Bloomberg screen. What that means is you need to be very careful about the quality of the capital that you raise. What I mean by that is it needs to be patient capital, people with medium to longer term views where you can harvest that illiquidity premium. Where you don't want to be is offer the illiquidity premium and on the other side let people have this false sense of security of being able to take their money out on a very liquid basis. Private can be actually a real positive. So being private side, you get even more information on a more timely basis than you do in public markets. So we are closer because we're on the private side to the companies we've lent to. We're getting monthly and quarterly reporting on every one of our positions. But that doesn't take away the risk. So the risk in private markets and the fact that you're illiquid, so once you make an investment, you don't get the luxury of being able to trade out of it like you do in a listed equity sense. So you need to really come up with a very sound credit process and a credit discipline. You get to say yes only once. Once you're in, you're strapped in for the ride, whether it's a nice smooth ride or one that's a hairy roller coaster ride. Understanding that you're investing on a buy to hold to maturity basis is the reason why you need to choose a very good manager who's got the experience of running it through a credit cycle, and understanding that there's a very disciplined approach to investing will mean that you can actually deliver a very good income with stability, with very low volatility through the cycle, and that's exactly what we aim to achieve at Revolution Asset Management. Some of the biggest risks that we see were partly completed construction of residential apartments, for instance, where we see there's already been a large increase in vacancy rates, particularly in New South Wales and Sydney in particular, where there's partly completed construction of these new towers. You know, what will be the experience when it comes time to settle those loans with people that have bought them off the plan? What is the recovery look like in retail when everybody's now used to buying a lot of their goods online? Will people be able to want to even get out of their lounge room and go out and go shopping for goods, where they can just go online? What is the impact to commercial office buildings? People are now really used to working from home. Even dinosaurs like myself, who were always used to coming into work and sitting in an office all day, having to adjust to a new world in almost a necessity sense. What does that impact when even large organisations are saying, well, maybe we can do with 50% of the office space? That could lead to quite a dramatic shift to an asset class that was formerly thought to be extremely defensive, but actually could come under quite a bit of valuation pressure going forward as a result of falling demand.